Knowing what the Fed is watching really helps you anticipate what's likely next. Don't guess, follow the data. So watch CPI inflation. Watch PCE, it's the Fed's preferred metric. Watch the jobs report. Watch the 10-year Treasury movement. These will tell you what to expect long before Jerome Powell steps to the podium. Hey everybody, welcome to another episode of Keeping It Real Estate. I'm your co-host Dan Brisse. Today we're going to talk about the Federal Reserve and why they matter. Our goal here and objective is to help you guys understand how the Fed policy decisions, they directly impact real estate investing. Every 6 weeks, the Federal Reserve meets and the entire real estate industry literally holds its breath. And the reason that is because a few sentences from the Fed can reshape debt costs, which affects valuations and it affects investor psychology, and it can affect deal flow overnight. Quick stat for you guys. So from March of 2022 to July of 2023, the Federal Reserve raised interest rates 11 times. And that took the Fed funds rate from near zero to over 5%. And that's the fastest tightening cycle we've seen since the early 1980s. And so that's just a little bit of a heads up of where we are or what went on over the last few years. Today, we're going to break down why these meetings matter and how their decisions affect multifamily investments and what you should listen for when the Fed is speaking. So let's clear up a common misconception first. The Federal Reserve does not directly set mortgage rates. What the Fed does control is the federal fund rate, which is the overnight rate banks charge each other. And the policy outlook communicated through press conferences and projections. That's what they control. What the market does is mortgage rates, commercial real estate debt rates, and the 10-year Treasury yields adjust based on the expectation of future Fed policy, the inflation data, and the economic strength. So in short, when the Fed raises rates, its borrowing costs rise, deals stop penciling, and valuations fall because debt becomes more expensive. Whereas the inverse, when the Fed cuts rates, borrowing costs fall, capital floods back, volume rebounds, and debt becomes cheaper so you can pay more for assets. It's really pretty simple. This is why every Fed meeting is treated like a market event. Point number one, how rate hikes hit multifamily. So let's put some real numbers behind this. Assume a property has a $20 million loan amortized at 30 years, not uncommon for a Fannie Freddie loan. At a 3.5% interest rate, the annual debt service is $0.08 million. If you raise rates and that you're now at a 6.5% interest rate, the annual debt service is $1,500,000. So almost a $500,000 increase by that interest rate going up, the 3%. That impacts your annual payment by $400,000 or $36,000 a month. So that's not a rounding error. That can consume the deal. It's going to eat all your free cash flow. It's going to kill your ability to refinance. And in many floating rate deals, it's going to throw off your entire debt service coverage ratio. So this is why the Fed's rate decisions cascade directly into multifamily performance. The second point is it clearly makes an impact on valuation. So as borrowing costs go up, buyers demand higher cap rates, and that hits property values. So here's an example again. Average U.S. multifamily cap rates were 4.7% in 2021. By late 2023, they were often in the 5.3 to 5.7% range, just depending on the market and the asset class. And if you just take a move from 4.7 to 5.5, it implies roughly a 15 to 18% decline in value if the NOI stays constant. So this is why brokers say interest rates are the gravitational force on real estate. When they rise, everything adjusts. The third point I want to talk about is market psychology. So the Fed meetings don't just move rates, they move sentiment. Investors study every word of the Fed statement. So hawkish tone would be, inflation remains elevated. Further policy tightening may be appropriate. Markets expect rate hikes. Borrowing costs rise. deal activity slows further. That's what happens when they are saying things like inflation remains elevated. It ends up having markets expecting higher rate hikes. If they're saying the further policy tightening may be appropriate, borrowing costs rise. A dovish tone would be if they're saying inflation has eased, rate cuts may be considered, then the markets expect rate relief and lenders loosen and buyers step back in. Sometimes a single sentence can literally shift the 10-year treasury by 10 to 20 basis points. And the 10-year treasury is what we use for a lot of these deals. It might affect CMBS and agency rates, multifamily buyer activity. It can affect cap rate expectations. So this is why operators, lenders, and institutional investors, they hang on the Fed's press conference more than the printed statement. So point 4, why it matters for operators. Financing risk is the biggest pressure point we're seeing coming into 25 and 26. So many owners who bought in 2021 and 2022 used floating rate bridge debt, and they're expecting to refinance when rates stayed low. Instead, SOFR went from 0.05% to over 5% in 18 months. And deals that underwrote at 3% to 4% debt suddenly faced a 7 to 8% floating rate payment. Since some operators saw their monthly debt service double or triple, that destroys all their cash flow. It destroys the ability to recapitalize, and then sometimes their ability to even hold the asset. So this is why the Fed decision can be the difference between a project stabilizing successfully or a project being forced into a very distressed sale. Here are some practical applications that you guys could be doing for multifamily investors that we're thinking about as we're looking at our deals. Number 1, we're watching the Fed calendar. Fed meetings, they happen every 6 to 8 weeks. If you need to refinance or close a loan near a meeting, rate volatility is very likely. Number 2, either lock in fixed rate debt or stress test deals at a 200 plus bips. So if the deal dies when debt costs rise by 2%, it may be too fragile. Number 3, track the Fed's real focus. Is it inflation? Is it jobs? These are the 2 primary pillars the Fed is going to respond to. If inflation's too high, expect rate hikes and delayed cuts. If jobs, though, are cooling, expect easing and cuts. And I think job growth cooling or job loss will trump inflation. And that's the part we're coming into right now for the market cycle. And, knowing what the Fed is watching really helps you anticipate what's likely next. Another piece to keep in mind if you're a real estate investor is don't guess, follow the data. So watch CPI inflation. Watch PCE, it's the Fed's preferred metric. Watch the jobs report. Watch the 10-year treasury movement. These will tell you what to expect long before Jerome Powell steps to the podium. And now, number 5th piece, if you're a multifamily investor, you don't need a PhD in economics to succeed in multifamily. But if you ignore the Fed, you are flying blind. Interest rates shape debt costs. It affects cap rates. It affects values and investor psychology. So understanding the Fed's decision gives you an edge every time you underwrite a deal. That wraps up this episode of Keeping It Real Estate. We appreciate you listening. Please reach out to us at www.granitetowersequitygroup.com/contact us. We'd love to get to know you and your investing goals better. Thanks for listening.